For the video lecture for Chapter 5, we have two parts. This is part 1. Here in Chapter 5, we're learning the accounting for a merchandising company. A merchandiser buys merchandise and resells it to their customers. In the past chapters, what we learned was a type of business called a service type business, where they're selling their labor or their skills or knowledge. Okay, so something intangible is being sold here for a service type. And it's simpler because you don't have to deal with the merchandise. But now we're going to account for buying merchandise and selling it here in Chapter 5. Now if you continue to Accounting 202 next semester, after finishing up 201, you need to have a CO better in 201 before you can move on to 202. You're going to learn another type of company called a manufacturer, where they're buying raw materials, and in the factory they're going to make something and then they're going to sell it to their customers. So generally there's three types of businesses. Of the three, the most complex is a manufacturer, and then merchandiser, because you have to deal with the inventory. That's not usually present in a service type business. Before we take a look at the debits and credits for a merchandising company, let's review the debit credit rules we had learned in Chapter 3. Let's use two T accounts. Remember, the left side of the T is called debit, abbreviated DR, and the right side of the T is a credit. No matter which account you're looking at, debit is left and credit is right. Now certain accounts are increased when you put the dollar amount on the left side, the debit side, and those accounts are reduced when you record the amounts on the credit side. And some other accounts, just the opposite rule applies. They're increased with credits and reduced with debits. So let's write here at the top of the T's the types of accounts that are increased by this rule here, that increase with debits. So if you remember, the things we own, assets, are increased with debits. And if you want to reduce an asset, you would record the reducing amount in the credit side of the asset T account. Now the opposite of things we own goes over here. And of course that's liabilities we owe. So their rule is to increase with credits. And when you pay off or reduce the liability, that reduction amount is recorded on the debit side of the liabilities T account. Another type of account that's recorded with debits and reduced with credits are expenses. Remember how we closed out the expenses by crediting the expense account? And the opposite of an expense goes on this side. Here is revenue we're earning. Revenues were recorded with credits and closed out with debits. Another type of debited account that has a normal increasing debit balance was the dividends. Every time you record or pay out a dividend, here debit dividends. So money going to the stockholder, dividend. Now when money came from the shareholder, when they bought their original ownership in the company, you remember the common stock account? That was recorded with a credit. Let's see, I think I'm missing something. Remember the using up of a fixed asset like equipment or building? We started to depreciate it. Well, the depreciation expense goes here, but the offsetting credit was the accumulated accumulated depreciation. The contra asset account goes over here. Anything else I need to do? Let's see, these three increase with debits, these four increase with credits. Okay, so that's the debit and credit rule. So if you need to remember before you start recording transactions, just rewrite these two T's here and then look at them when you have to refer how to debit and credit an account. Okay, so merchandising companies, so the big box retailers here, they basically are here and they buy merchandise from wholesalers or distributors, or some people call jobbers, or even straight from the manufacturer. Okay, so now they have to stock that inventory in their store shelves and maybe their warehouse, and then the customers buy it from them. Yeah. Okay, so this here step of getting that merchandise to your company is called purchasing or purchases. And here, when you have customers buying that merchandise, we call that sales. Many times these customers are not just consumers like you and me, but they could be other companies buying in large quantities from a merchandiser here. So here is the sales. This is a new account name we're going to be using for our revenue. Remember, we had service revenue or service fee revenue in the past couple chapters. Whenever a merchandiser sells merchandise, they're going to record the revenue in their sales account. That's probably going to be the biggest account on the income statement. But when they record the sale, now they have to record how much they paid their supplier for that same merchandise they sold to their customer. And that amount is called cost of goods sold. It's kind of a long name here for an account. So in the case of a merchandiser, this is probably going to be the biggest expense they're going to deduct on the income statement. So here is the sales price we're eventually going to get from our customers, or this is our customers' cost. And for the same merchandise we sold to them, here is our cost, how much we paid for that same merchandise to our suppliers. And the difference between the two is called gross profit. Okay, sales is an account, a revenue account. Cost of goods sold is an expense account. And we know revenue and expenses appear on the company's income statement financial report. And we take the difference between the two and we get this figure here. The gross profit is not an account. The gross profit is the difference between these two accounts. Remember how revenue is recorded with a credit and expenses recorded with a debit? Whenever you combine debits and credits together, you never add them. We learned in chapter 3, you always take the difference, leaving you a gross profit credit balance. And with that profit, now you can pay off, now you can fund all the other expenses of your business. Here it's called operating expenses. And typically they consist of the same type of expenses we've been seeing throughout the chapters, the semester so far, like salaries, utilities. All of those stuff are operating expenses. And when you subtract out those expenses that were recorded with a debit from this gross profit that has a credit balance, then the remainder is our bottom line of the income statement, the net income. Although if you have too many expenses here, you're going to end up with a net loss, which we don't want. Okay, so basically this is how the numbers are flowing, and as all of these are going to be appearing on the company's income statement. Here is the flow of how things work back in the chapters 1, 2, and 1, 2, 3, 4. A service type business where we use cash to eventually buy supplies and pay for costs for running our business. Here an auto mechanic will have to buy supplies and pay the employees. And when we finish the work on our customer's job, we can either collect the money back here again, or we can bill them and wait for the money. And we call that an account receivable asset that we saw in past chapters. So we're waiting, and here's the check coming in the mail. Now we got the money. So this flow here of the funds is called an operating cycle. The time it takes to buy costs, incur costs to do your work, and then to bill your customer, and then wait to collect the money. Now you can pay off your bills again. That's called one operating cycle. But in the case of a merchandising company, the operating cycle is even longer. The reason why is because now we have this stuff we have to take care of called inventory. So here we order inventory and we get it delivered. Now it's sitting in our store, sitting in our warehouse. This is a huge thing now you have to manage. It may give you lots of headache. Then eventually you sell it to your customer. Either you collect the cash right away, or for big customers who order in bulk, you can bill them, creating an account receivable asset, and then eventually you'll collect the cash and you can pay off the bills you have. Of course, the big bill is the merchandise you had bought. But just to get this flow started, you already have to have some money in the system called working capital. You can't expect to buy stuff without any money. Suppliers are not going to pay you, let you buy merchandise without some type of credit, some type of backing. Yeah, so you already got to have some money in your system here flowing. And if you don't, you're going to be what we call undercapitalized, and you're probably not going to be able to succeed in your business. So here is the, it's almost like a calculation of how to determine how much cost of goods that was sold to your customers. Not the sales price now, but your costs of what you sold to your customers. So here is what you hadn't sold from the last year or the last month. And then during the month, you bought some more from your suppliers. If you add up these two amounts, the total is the cost of what you can sell to your customers. And again, you're going to sell it at a higher price, but this is your cost, the seller's cost. So here is what's being sold to the customers. Again, cost of goods sold. And you're going to sell it at a higher sales price. Remember, we take the sales price and minus out the cost of goods sold to get something called gross profit. Now, you didn't sell all of this because if I look at your store at the end of the month or year, sitting on the shelves are unsold items, and that's called ending inventory. Okay, beginning inventory plus the stuff you buy during the year, called cost of goods purchased, is equal to the maximum you can sell at your cost, called cost of goods available for sale. And there's only two things you do with this. Either you sell it, cost of goods sold, or you don't. Stuck here as ending inventory at the end of the month or end of the year. Now this amount is going to be the beginning inventory for next month or next year. And next month or next year you're going to buy some more, and here's what's available for sale again. And then you sell most of it hopefully and end up with very little, so you don't have to carry over that inventory to the next period. So let's review that calculation again. Let's say this box here represents your store or warehouse. Okay, let's just call it your store. So sitting in your store are lots of shelves, and on those shelves are merchandise that you're going to sell to your customers. And that's at the beginning of the year. What's sitting on the shelf is called the beginning inventory. And then during the year, you're going to buy more stuff and put it in your store. We call that purchases. Purchases. Okay, so you're adding it to your inventory here, this purchases, merchandise purchases. So what you start off with plus what you buy during the year, this total right here of the two is called cost of goods or cost of merchandise available for sale. And again, there's only two things you do with it. Either you sell it, that's called cost of goods sold, let's say to your customers. Gotta be to your customers. Here, these purchases are coming from your suppliers, or sometimes we call them vendors. Okay, and again, everything here is your company. So all of this, cost of merchandise available for sale, here's what's sold. We take it out of our store. And then what's left over is called the ending inventory. That will be the beginning inventory for the next period. So these two, if you add them together, has to equal these two. And the thing they equal to here in the middle is called the cost of merchandise, or the cost of goods available for sale. Okay, so this is a key number here. If I give you 1, 2, 3 of the 4 different amounts listed here, you should be able to figure out the missing amount. All we're doing is basic addition and subtraction. So there's two types of how you can picture the cost flowing. The type we're going to be learning and concentrating on in this chapter is called the perpetual method, we perpetually know, we always pretty much know how much cost is sitting in our store, how much merchandise we have in our store, because we're keeping track of what's coming in perpetually and what's going out perpetually. And we know the balance of that inventory sitting in our store or warehouse. That's again called the perpetual method, the perpetual system. If you took our accounting class maybe 3-4 years ago, you would learn another system called the periodic system, where you still keep track of things coming in and going out of your store, but you don't have a good detailed record of that. What you do instead is that at the end of the period, you go through your store and get a real good count of how much is sitting on the shelves and in your warehouse. We call that ending inventory. And then you know how much your beginning inventory was, because that was the ending inventory of the last period, and you kept track of how much you bought during the period. So if you add these two up, again, there's that total cost of goods available for sale. You would subtract out how much you didn't sell, because you got this count. A physical count is called a inventory, ending inventory, and then you subtract it out, and that'll figure out the amount of the cost of your merchandise that is in the hands of the customers. Remember, this is at your cost, not the customer's cost. The customer's cost is the sales price, and you subtract it out from the cost of goods sold to equal your gross profit. This is called the cost of goods sold calculation, because this is the bottom figure you're trying to eventually calculate. This will work here for the perpetual, the periodic and the perpetual method. You'll actually will see this inside of the company's income statement, no matter if they use the perpetual or the periodic. So most times we kind of use a combination of both periodic and perpetual, but we're focusing on, in this chapter, the perpetual method and a little bit of the periodic method. Now there's an appendix at the end of this chapter 5, just strictly dealing with the periodic method, telling you how to record debits and credits under this system. You can ignore that, yeah? Just focus on the perpetual method throughout this chapter, and the little bit it says within the chapter about the periodic. More information about periodic. Basically, here it says it requires a lot of more work. Well, the reason why perpetual is becoming more popular is because a lot of this work is being done by computers that perpetually can work with less people, less costs. Okay, so more and more perpetual method is becoming popular. You can even see it, just by going to a store. Things are being rung up, not just by people pushing buttons on a cash register, but it's being scanned electronically, so it can be done really fast. So you think, when you scan that merchandise at the checkout counter, they're just using it for ringing up your total amount you owe. But what's also actually happening at the same time, they're reducing their inventory record. So they always know how much they have on hand, not just sitting in the shelf where you just picked up the item, but also how much is in the back warehouse. And they can tell when they need to order it or restock their shelves. Here is an example of a bill. In accounting, we call that an invoice. And of course, in most transactions, there's always 2 points of view. The point of view, if you're the seller, here it's called PD Audio Supply Inc. is the seller. This would be a sales invoice. Or if you're the customer, here SOC Stereo, this would be a purchase invoice. So we'll take a look at this invoice from those 2 points of view. Both are merchandising companies. Okay, so PD Audio Supply would be the wholesaler. SOC Stereo would be the retailer. In turn, SOC Stereo would sell to consumers, people like you and me. So here on May 5th, PD Audio sold to stock 2 different items. Here, a printed circuit board, just one item at this price, at this total cost. And then looks like 5 production model circuits, each at 300. So if you multiply across, we call that extending out. You get this cost, and you can foot down. That's foot means to add to get this total cost. And of course, if there was some sales tax, they would tack it on. If there was a delivery charge, they may tack that on. If there was a service charge, they would tack it on to get the total cost down here. Okay, so the date is May 5th. The salesperson for PD Audio is Malone, who had got an order from James Hoover, the purchasing agent for Salk. So these two guys are in communication regarding this transaction. When they say terms, term means time. This is the time limit you get to pay off or collect the money here. This 210 means there's going to be a 2% discount given by PD Audio to Salk, reducing the bill, if this bill is paid within 10 days of this date. Otherwise, here this net 30 and 30, this whole amount would have to be paid by 30 days from this date. There's two different ways of billing a customer. One is by individual invoices. So if Salk buys some more from PD Audio, they definitely would get another invoice. But also some of the sellers may supplement all these different invoices by giving another report called a statement at the end of the month, showing all the different invoices that were issued to that customer during the month, minusing out any payments received by the customer during that month, leaving a balance still owing that has to be paid by a certain due date, and maybe tacking on interest if it wasn't paid on time, or if there's a balance being carried over from month to month. Okay, so billing by invoice or billing by statement. Here we are assuming billing by invoice in our example. So let's take a look at the journal entry from the viewpoint of the buyer Salk. They're buying $3,800 of merchandise. So when they get this bill, when the merchandise is delivered, then the transaction is completed. It may or may not be on May 5th, it could be a little later, but whenever the date that happens, we now have to record the transaction. And we know from chapters 3 and 4, we record transactions in the general journal. So we write down the date, we write down the name of the account being debited, next line indent name of account being credited, and the amount of the debit and credit in those two columns. So what do you think we're debiting when we buy this merchandise? Well, here's a new account. Merchandise inventory is an asset we own. Assets are increased with debits, and we're increasing that debit asset, right, by this cost here. Let's record the credit. We're not going to pay right away because we're given time, we're given terms to pay off our bill. So right now we owe. Owe is a liability. Liabilities are increased with credits. And the standard liability account we use when we owe a vendor is called accounts payable. Okay, so here's the general journal entry from the viewpoint of the buyer. And later on we'll see the viewpoint of the seller, PD Audio. There's terms regarding the delivery of the merchandise. Let's go back and take a look at that invoice again. Here it says FOB, not fresh off the boat, but free on board, and then the next term tells you who's going to pay the shipping costs. Shipping point means, well, let's take a look at the illustration. So here in this example, they illustrate shipping point. Here's the seller, and here's the shipping docks of the seller. And they're going to leave the merchandise right here for the buyer to pick up at this shipping point right here. And now it's the buyer's responsibility to pay for the shipping to their own store. Now it is possible, and most times it's true, that the seller will arrange the shipping for the buyer, but the buyer would still pay for it, and the seller would tack on a shipping charge over here. But in our case here, PD Audio didn't tell the seller to arrange for the shipping, so PD Audio probably arranged it themselves. Here's a shipping company, and now once the shipper picks up that merchandise is owned by the buyer. The buyer is responsible for the merchandise along the way here. Okay, so the seller gets rid of it at the shipping point. The buyer takes it over and pays the shipping cost from this point. And again, the seller can arrange the shipping and tack it on the bill, but it's going to be charged again to the buyer, FOB shipping point. The opposite of FOB shipping point is FOB destination, where the seller is responsible for the merchandise and pays the delivery costs all the way up to the point of destination. So the buyer takes it over here without paying the shipping costs. Again, here's our terms, for the sale we just saw. The buyer has to pay for it. So assume upon delivery of the goods, SOC has to pay the shipping company $150. So this is a journal entry we got to record. We got to record a debit of $150 and a credit of $150. Whenever you're paying for delivery costs to get merchandise to your own store, you're buying merchandise, the account we debit is the same one we debited when we buy the merchandise. And that's going to increase the merchandise inventory asset. Okay, debit. And the offsetting credit, if you pay cash, you credit cash. If you get an invoice delivery bill, then you would credit the accounts payable liability. In this case, we paid for it. Let's see. Assume that the freight costs was paid not by the customer but by the seller, PD Audio. So there would be, of course, no entry on the buyer's book if the seller paid for it. So let's take a look at the journal entry for the seller. Again, there would be a $150 debit and a $150 credit. The account being debited cannot be merchandise inventory because PD Audio is not buying merchandise. They're selling the merchandise. So the account we're debiting is called freight out or maybe delivery. I would like to see the word expense to make it really clear what type of account it is. We know expenses are deducted right away on the company's income statement. Okay, freight out expense. And let's see, they paid, so cash would be credited for $150. This is from the seller's point of view if they had to pay for the shipping, and this is the buyer's point of view if they had to pay for the shipping. And of course, only one party of the two would do that. What happens if the customer is dissatisfied with the merchandise they bought, either because it was damaged or defective, junk quality, or it was not what they expected or what they ordered? Well, typically the buyer would contact the seller confirming they want to send it back, getting permission to send it back, and we call that a return. From the viewpoint of the buyer, it's called a purchase return. From the viewpoint of the seller, it's called a sales return. A similar situation of returned merchandise is when the seller tells the buyer, why don't you keep that damaged, defective, inferior thing maybe you didn't order item, but what we'll do instead is reduce the price you owe. We call that an allowance, when you reduce the price and you don't have to return the item. From the viewpoint of the buyer, that's called a purchase allowance. From the viewpoint of the seller, it's called a sales allowance. So you kind of combine these two together and you may call it a purchase return and allowance or a sales return and allowance. So we have a situation of something being returned. SOC Stereo, now on May 8th, wants to return to the seller $300 of merchandise. And of course, because SOC is such a good customer, PD Audio allows that under their terms of returning items. So we know we're going to have to record on SOC's book a debit and a credit of $300. Now what do you think you're going to debit? Well, if you remember the things we debited and credited at the time you bought the merchandise, those two accounts are now reversing the debit and credit. That's reducing the accounts payable liability with a debit and reducing the merchandise inventory asset account with a credit. Okay, remember we had done the opposite when we bought it. Now we're doing the opposite, debit and credited accounts when you return the merchandise. Makes sense, right? So what would happen? Well, this is another situation now where we're going to motivate the buyer to pay off early. Remember those terms? We get a 2% discount if you pay within 10 days of the sales date. Otherwise, the whole bill is going to be due within 30 days. Some other situations besides the 210 net 30 could be 110 EOM or end of the month, where if you paid according to this description within 10 days into the next month, you get a 1% discount. Or no discount at all, but you still have to pay it within 10 days of the next month. For SOC, if you remember that invoice, the purchase invoice, there was that terms of 210 net 30. That was May 4th or 5th, and we're paying off the bill within 10 days. So you don't have to pay back the whole 3,500. Remember, we initially bought the 3,800, but you have to reduce it by what you return. So we still owe 3,500. But because we're paying off this bill within the 10-day discount period, we're going to get a 2% discount. And when you make this payment, SOC has to journalize this transaction. Remember, the journal entry we recorded before was just to buy the merchandise without paying for it and returning $300 worth. Now we're paying the bill here on May 14th. So let's debits go first. The amount we owe, because we don't owe it anymore, we're going to reduce the liability for the full 3,500. Now what you're going to credit is not cash for 3,500 because you're getting a discount. 2% of 3,500, that's $70 of discount going into the merchandise inventory. Remember, this is our asset account here being credited, so you're reducing that asset. Okay, so the discount is going to reduce your costs. Yeah, so here we're reducing the cost of the asset with a credit. And then we can see that we need still more credits to total up to this big debit. And of course, here's the one we don't like to do, because here's money going out of your pocket. Cash being credited for really 98% of this 100% amount, because we got a 2% discount here. Okay, 2% of not the 3,800 initially we bought, but we reduce it by the 300 we returned or allowance given to get the net amount that we now take the percentage discount on. Okay, so what if that customer didn't pay off by the 10 days? Well, it's going to be due within 30 days. Yeah, so on June 30th, now they're going to pay off the full amount. So just like we saw before, you're going to zero out the liability with a debit, and then the offsetting credit, there's no discount, so you got to pay the full balance here of 3,500 crediting cash. Now, should you take advantage of this discount? It's only 2%, right? Well, you're earning 2% over a 20-day period. Okay, and if you try to annualize that, that's going to be using this calculation here. If you try to convert this 2% for 20 days into a percentage for the year, here's the annual percentage that you're earning, 36.5%. Now, where can you invest money or save money at a rate of 36.5% per year? Well, right here, 2% every 20 days by taking this purchase discount and paying off your bill just 20 days earlier, right? Remember the 210? You're paying it off within 10 days. Otherwise, you got to wait another 20 days and pay it within 30 days. Just by paying off early 20 days, you're earning this annual rate here. So take it. What you're looking at here is the merchandise inventory T account. Again, debits, this is an asset account, increase, and credits decrease. So when you bought the merchandise on May 4th, you debited this account for the full purchase price. But then a few days later, here on the 8th, you return, crediting the amount you returned. And then you paid the shipping costs, here $150, increasing the cost of this asset. And then when you paid off your bill, You of course credited the cash asset, but then not for the full what is that, 30, is it 32? Wait, is something wrong here? Should this be 38? I think it's 38, yeah, when we bought it. Yeah, okay, that entry is wrong. This should be 38, reducing it by 300, so that nets out to 35. So when you pay off your bill, you don't pay off the full 35. You're gonna pay off $70 less because of this discount we're recording. Okay, so that's the inventory account, this new account keeping track of our merchandise. Eventually, when we sell the merchandise, it's going to come out as a credit. Here's the end of part 1, and continue into part 2 to look at more transactions being journalized for a merchandising company.